Keeping some money in the bank is okay, but putting lots of money in the bank? Maybe not. Why? The average inflation rate has been around 2 to 3% annually. So whatever cost $1 this year could cost $2 or $3 next year. And that $100 bill you kept in the bank last year would probably be $98 next year. Get the drill? So you either break even with bank interest or your money keeps depreciating. It's like freezing your money in time, and that doesn't sound like an investment to me. Want to hear 5 investment options that are way better than clumping your hard-earned dough in the bank? Stick around. First on the list is 1. Gold. While traditional savings might be a slow dance, gold is the rock concert of investments. It's been a symbol of wealth since Cleopatra's era, and here's the kicker: it doesn't corrode or tarnish. While some financial advisors might tell you to keep your money in dollars because the US is currently a world power, gold is far more reliable than the dollar because if some other country like China or Japan overtakes the US, your dollars might actually take a dip. So yeah, your dollars might age, but your gold stays perpetually stylish. Prior to the 1950s, an ounce of gold could be purchased for $400. Fast forward to 2023, and the same ounce is valued at over $2,000. According to Prime XBT's gold forecasts, this figure is projected to rise to $10,000 by 2032, indicating a 5-fold increase in the next decade. While cash tends to depreciate, the value of gold continues to climb. Additionally, other precious metals exhibit similar trends, making them preferable to holding excessive cash in the bank. Also, a significant drop in the value of a particular currency often translates to an upswing in the gold price denominated in that currency. This proves especially beneficial for individuals residing in countries grappling with economic instability or hyperinflation. Putting money in the bank is smart, but too much cash savings can actually be a problem. In times of economic or geopolitical turbulence, investors instinctively seek refuge in gold. Its track record of retaining value outshines other assets during the crises, earning it the status of a safe haven asset when financial storms loom. Unlike fiat currencies, susceptible to unlimited printing, gold supply is finite. This inherent scarcity plays a pivotal role in maintaining its enduring value, contributing to its appeal as a stable investment. However, despite these advantages, gold doesn't navigate the financial landscape without risks. Its price can exhibit volatility in the short term, lacks income generation like dividends or interest, and entails associated costs for storage and insurance. Alternatively, you can explore gold exchange-traded funds for exposure. As with any investment, a prudent consideration of these factors is paramount. Yet in the last decade, gold has outshone many traditional investments, proving that while all that glitters isn't gold, gold indeed does glitter. Now let's talk real estate, the heavy hitter in the world of wealth building. 2. Real estate. Your money might be yawning in the bank, but in real estate, it's throwing a party. Ever heard the saying, "They're not making more land"? It's not just a catchy phrase, it's the heartbeat of real estate investing. Owning property isn't just a financial move, it's planting seeds for a future financial forest. According to a Bloomberg study, housing prices have tripled between 1992 and the 2020s, despite a significant dip during the 2008 housing bubble. Consequently, having exposure to real estate proves beneficial when the value of the dollar is diminishing. However, many small investors tend to consider real estate much later in life, often associating it solely with the house they live in. Real estate also shines as an investment of choice, offering appreciation over time and a reliable income stream through renting. It serves as a robust hedge against inflation, with its value and rental income rising in sync with economic shifts. Tax advantages sweeten the deal, including deductions for mortgage interest and property management costs. Leverage enhances returns by allowing investment in a larger asset, and real estate's tangible nature provides control and flexibility. Adding it to your portfolio reduces risk through diversification, making real estate a dynamic and multifaceted investment opportunity. Quick fact: in a recent study, it was found that real estate investments have historically outperformed stocks and bonds, making it a heavyweight contender in the wealth-building arena. Now let's pause for a moment. Thinking of converting your wealth into gold or into some fine real estate? Hit that subscribe button because we've got more insights coming your way, and you won't want to miss a single golden tip. All right, time to stir up the financial cauldron with a dash of S&P 500 magic. 3. S&P 500 Index. Ever feel like investing is a jigsaw puzzle and you're missing a few pieces? Enter the S&P 500, the maestro of the stock market symphony. It's not just an index, it's the VIP pass to 500 of the biggest players in the US stock market. Like a front row seat at a concert, it gives you a taste of the financial crescendo without having to pick individual stocks. Investing in the S&P 500 index is often considered a wise move, surpassing the appeal of holding cash, and it all boils down to the enticing prospects of higher returns and the enchanting power of compounding. Let's dissect why the S&P 500 is frequently celebrated in financial circles. Over the last 50 years, the S&P 500 has delivered an average annual return of around 10%. That's like having a financial genie granting wishes in your portfolio. Historically, the S&P 500 has delivered returns that leave traditional savings accounts in the dust. With an average annual return of approximately 10%, including capital gains and dividends, it stands as a reliable performer over the long term. It's like having a financial maestro consistently orchestrating a harmonious tune of growth. Embracing the S&P 500 is like putting your investments on autopilot. This index follows a passive investment strategy, requiring minimal time or expertise in managing individual companies. It's the financial equivalent of a smooth, hands-off ride for those who prefer a straightforward approach to investing. Diversification also becomes a built-in feature when you invest in the S&P 500. With exposure to 500 of the largest companies in the US across various industries, the risk associated with poor performance in specific companies or sectors is significantly mitigated. It's a strategic move to shield your investments from potential turbulence. Beyond capital gains, many companies within the S&P 500 generously pay dividends, creating an additional income stream for investors. The beauty lies in the option to reinvest these dividends, amplifying the growth potential of your investment. The S&P 500 doesn't just promise short-term gains, it's on a consistent upward trajectory, setting the stage for potential capital appreciation over the long term. This slow and steady climb is a testament to the index's resilience and reliability. In an era where prices seem to only move in one direction, up, investing in the S&P 500 becomes a formidable ally against inflation. As businesses adjust prices over time, their profits follow suit, providing a robust defense mechanism for your purchasing power. Now let's talk about the magic word, compounding. The combination of reinvesting dividends and the overall upward growth trend transforms your investment into a financial powerhouse. It's not just growth, it's exponential growth, showcasing the true power of compounding. This compounding effect turns your investment from a mere seedling into a towering financial oak. Let's wrap up this financial fiesta with a soothing touch. 4. Treasury inflation-protected securities. Tips. If your money is losing its value by the day due to inflation, all you need is tips. Treasury inflation-protected securities, TIPS, are government-issued bonds designed to protect investors from inflation. Unlike traditional bonds, the principal value of TIPS adjusts based on the changes in the Consumer Price Index, CPI. This ensures that both interest payments and the principal amount increase with inflation, providing investors with a hedge against rising prices. Upon maturity, you receive the adjusted principal or the original principal, ensuring your investment remains robust in the face of inflation. The appeal of TIPS extends to risk reduction, given that they are issued by the U.S. Treasury. This government backing makes TIPS a low-risk investment, as they rely on the formidable ability of the U.S. government to tax its citizens. While TIPS may not boast the high yields of stocks or corporate bonds, they outshine the interest rates offered by typical savings accounts, especially in an environment of rising inflation. This positions TIPS as a prudent choice. TIPS can be bought and sold in the secondary market, providing a level of liquidity, albeit not as robust as that of regular Treasury bonds. For those who prefer a hands-off approach, TIPS exchange-traded funds offer a convenient avenue to tap into the protective prowess of these inflation-defying securities. Now let's talk about an investment that literally stands on solid ground. 5. Industrial commodities. Scarcity is one reason why precious metals are considered valuable, but industrial commodities offer another dimension with their natural utility value. These materials, such as silver, play a crucial role in various industries, including electronics, medical equipment, and nuclear reactors. Similarly, metals like cobalt, nickel, and copper are in high demand due to their unique properties that are challenging to replicate with alternative materials. To illustrate, the demand for cobalt has surged since 2020, primarily driven by its essential role in manufacturing batteries for electric vehicles. Consequently, its prices have experienced remarkable growth, increasing from $20,000 per ton in 2012 to $40,000 in 2022, marking a 100% rise in just a decade. While investing directly in raw materials may pose challenges for some investors, alternative options include investing in stocks of mining companies like Rio Tinto, mining-focused mutual funds, or derivatives such as futures and options. These avenues provide investors with exposure to the potential growth in high-demand phases of industrial commodities without the need for substantial sums of money or physical storage. As we wrap up this financial adventure, we're eager to hear your thoughts. Which wealth-building strategy are you most excited to explore further? Gold? Real estate? Share your game plan in the comments below. Want to get more insight on how to build your financial capacity? Watch this video displaying on the screen.